The housing market looks calm in headlines and chaotic in real life. That gap matters because it can change how you buy, sell, rent, or wait. And the weird part is this: the market is not moving in one clean direction. Some listings stall, some rentals jump, some buyers vanish after making offers. In the Bigger Pockets on the Market, episode 426, the panel describes a spring market that feels unstable, not dead. Their core warning is simple: inflation is still shaping housing. That concern lines up with federal data. The Bureau of Labor Statistics says the Consumer Price Index tracks prices paid by consumers, while the Producer Price Index tracks prices received by sellers. That distinction matters because rising producer costs can pressure future consumer prices. It is not a perfect chain, but it helps explain why one hot inflation report can shake mortgages fast. Freddie Mac's mortgage survey shows 30-year fixed rates were still elevated in May of 2026. On May 21st, the average 30-year fixed rate was 6.51%, up from 6.36% a week earlier. High borrowing costs keep hitting affordability, builder math, and investor demand at the same time. The panel's takeaway is that expensive debt may hurt commercial real estate first. Apartment owners with floating loans or expiring terms can face pressure long before a typical homeowner does. Fannie Mae's first quarter 2026 multifamily update adds another layer here. Its serious delinquency rate rose to 0.78% as of March 31st, up from 0.74% at the end of December. That suggests stress is building even before it becomes a mainstream housing headline. Then there is the local reality. In the episode, Seattle land values for some development sites were described as sharply lower than peak pricing from a few years earlier. That fits a broader pattern. When debt gets pricey, land and value-add projects often feel it first because holding costs and construction timelines can crush returns before the building ever sells. And Seattle's broader commercial backdrop helps explain why. In the first quarter of 2026, Cushman & Wakefield said downtown Seattle office vacancy hit 36.5%. Axios, citing the Downtown Seattle Association, reported that the 10 highest value downtown office properties had seen assessed values drop by more than 50% since 2021. That does not prove every parcel is cheap, but it does show how rate pressure and falling income expectations can reset what buyers are willing to pay for future development potential. But weakness in one corner can create opportunity in another. The hosts argue that soft pricing on land or fixer properties may improve long-term buying chances for investors who can carry risk. In plain English, if you are one of the few buyers who can survive slower lease-up, higher insurance, and pricier debt, you may be competing against fewer aggressive bidders than you would have a few years ago. Think of it like a traffic jam after one accident. Everything behind it slows, even the cars that were fine. In housing, one rate shock can freeze many decisions at once. Builders delay starts. Sellers cling to old price expectations. Buyers recalculate monthly payments. Lenders tighten terms. And suddenly, the market feels broken, even though transactions are still happening. The episode also captures another truth about this market. Some affordable homes still move, while pricier urban inventory sits longer. That split makes national averages less useful on the ground. A median price chart can hide a huge difference between an entry-level house with functional financing and a luxury listing that needs the perfect buyer to show up. The most practical warning in the episode may not be about rates at all. It is about fraud. And that warning is backed by a very recent criminal case. The Associated Press reported that former Brooklyn judge Edward Harold King and developer Yachil Sam Spry were charged after prosecutors alleged they swindled investors out of millions through a fake property bid. According to the report, investors were told to wire $6.5 million into what they believed was a protected escrow account for a New Jersey bankruptcy auction. Prosecutors said the money was supposed to remain untouched and returnable on demand. Instead, much of it was allegedly moved within days, and only part of it was returned. That is why the panel keeps stressing structure over charisma. If money is not tied to documented property rights, real escrow controls, and legal review, a fancy title means very little. A judge, a developer, a confident operator, none of that replaces independent verification. Before wiring funds, investors should be asking simple questions that feel boring but matter a lot. Who controls the account? What exact property interest is being purchased? What written agreement governs the release of funds? And who, besides the promoter, can confirm the deal is real? Another major topic was build to rent. The Real Deal reported that the House version of an amended housing bill dropped a requirement that would have forced some build-to-rent properties to be sold within 7 years. The article also said lawmakers removed a stricter institutional buyer provision from that amended package. The political details may still shift, but the message for supply is important. Housing Wire reported on May 20th that the House passed the amended Road to Housing Act by a 396-13 vote. The revised version stripped out the proposed 7-year sell-off mandate for new build-to-rent communities. So, at least for now, the House is signaling that forcing an early sale of rental inventory could reduce, not increase, housing options. If builders expect fewer forced exits, more projects may pencil out. And when more units get built, renters at least have a better shot at more choices. That does not solve affordability overnight, but stopping supply before it arrives usually makes a shortage worse, not better. The panel strongly argues that renters need new homes too. On rents, the episode highlighted markets moving in very different directions. Zumper's national rent reporting has shown strong annual gains in places like San Francisco, while some Sunbelt markets softened. Zumper's latest national rent report shows just how uneven that map really is. In its latest table, San Francisco one-bedroom rents were up 19.9% year-over-year to $3,850. Seattle one-bedroom rents were up 3.7% year-over-year to $1,970. Zumper's Seattle market page also puts the city's overall median rent near $1,975 as of May 2026. Austin, by contrast, was down 1.3% year-over-year at $1,480 for a one-bedroom. That mismatch matters. A city can have weaker home prices and firmer rents at the same time. For investors, that can improve cash flow math even if headline appreciation is muted. So, the real lesson from this episode is not panic, and it is not blind optimism. It is that housing is fragmenting. Inflation, rates, policy, fraud risk, and rent trends are all pulling differently. If you want to move well in this market, focus less on one big national story and more on your exact deal, your financing, your local rents, and your downside plan. The market is confusing for a reason, but confusion also creates openings for people who stay skeptical, stay liquid, and check the paperwork before they chase the promise.